So there are two words that, when used in association with the housing market, tend to cause a bit of excitement and chaos in the industry. Now, back in the last housing crisis, the Fed people, Alan Greenspan, Ben Bernanke, used these words to describe the housing market, but from their perspective, everything was going to be okay. Well, guess what? Those words were spoken by another member of the Fed the other day. What are those words? The words exuberance and the words froth. And we're going to talk about that right now. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back into real estate. Today is March the 31st, the end of the month. Yes, I couldn't help myself. I had to do a video today because I was so interested in what was said about the housing market. So once again, what were the words that were used? Well, the word exuberance and the word froth with respect to where the housing market is currently at and where it's going. Today, this video is brought to you by our friends at Foreclosure.com. If you want to find out or take a look at what's going on in your neck of the woods, your own backyard, Foreclosure.com has got it's number one place where you can find the most distressed listings across the nation. Go to my link. It's gethousingdata.com. That's gethousingdata.com. You can check out what's happening in your backyard. So thank you once again. All right. So why do I think this is very important? Well, kind of like my last video, is that things are starting to change now. Things are going, the needle's pointing the other way. The ball's bouncing in this court now. And more people are talking about the housing market. So really, we've had the run-up in prices, double-digit appreciation, low inventory, and now we have, guess what? Huge, very huge, and increases in mortgage interest rates occurring over a short period of time. So this is what they're talking about right here. So essentially, a report from Bloomberg, U.S. home prices show signs of becoming unhinged from fundamentals like they did in the housing bubble that preceded the 2008 crash, according to a blog post by the Dallas Federal Reserve Bank. Our evidence points to abnormal U.S. housing market behavior for the first time since the boom of the early 2000s. So basically, they're citing data to measure exuberance, all right, on property markets that they've developed with scholars around the world as part of the International Housing Observatory. So the measures suggest that the U.S. housing market has been showing signs of exuberance for more than 5 consecutive quarters through the third quarter of 2021, they wrote. Surge in home prices has continued since then. Basically, what they're saying is that their main takeaway is that the price to rent ratios have soared beyond what those fundamentals alone can explain and have moved into the exuberant stage. So when I go into like housing bubble theory or housing bubble theory 101, that's sort of the top part of the bubble. Like, in other words, everybody is going, this is great. We think it's going to keep going up, keep buying, keep pumping that bubble. What could go wrong? All right, that's the exuberance, because nobody's contemplating any sort of slowdown, shift, crash, crisis, whatever it may be that happens in the future. The exuberance position means that no one cares about that. No one's considering that. And that's where we get into problems, because people will still buy or still invest, and they could get caught when things do change. So that I found was very interesting that they actually came out and said that. So there you go. They also found that the surge in disposable income due to pandemic-related fiscal and monetary stimulus, as well as reduced household consumption because of mobility restrictions, may have lessened its usefulness as a gauge, suggesting that any bubble may be more advanced than those numbers suggest. So basically, that's a very interesting statement. So as much as they're saying there's an exuberance and that we've got bubbles going on here, it could actually be an understated bubble, and the true bubble could be worse than often we think it is because of this, I guess you could say, fiscal policy and monetary stimulus. And quite frankly, when you go look at that, this did come out the other day as well, too. This is kind of neat. Fed finally admits that COVID stimulus is responsible for hottest inflation in a generation. So remember, we had people who weren't working or didn't have to go to work that could hunker down, reduce expenditures, getting stimulus money, playing games in the stock market, playing in crypto, playing in real estate. So, it was an interesting time. It was a tough time, but an interesting time. But yeah, a lot of this was, SBA money, stimulus money, whatever it was. And guess what? That's gone on record now as saying that's actually caused this inflationary position that we're in. And that we should take note of that, obviously, as we're moving forward in the housing market. So now we get around to Froth. So, of course, I'll just go to the bottom paragraph here. Basically, the risks lie in housing markets. You don't need to look far for evidence of froth in the residential property market, with global home prices running well above their trend in what looks alarmingly similar to the run-up to the 2008-2009 financial crisis. So yet, every day we see there's more economists, more analysts, more people that know what they're talking about. They're looking at things from a macro perspective with the inflation, interest rates, the economy, political issues going around the world as a whole. But a lot of it is pointing back to, the housing market is poised to suffer because of this. Now, as I said, the debate is still up as to how it's going to play out. But, at least what we're getting now is we're getting people saying, guys, we got a problem here, okay? That stuff is beyond, normal. We're into that exuberance, out of control stage. And when that happens, there's really only one thing that happens. It has to correct at some point in time in the near future. So I guess, we're on record as saying that's what these guys are talking about here. This guy, he's the CEO of the National Association of Home Builders, says housing market staring into the face of a perfect storm. All right, the expert warns. Basically, he argued that it's a bad sign for the American economy. Of course it is. Our own Wells Fargo, housing National Association of Housing Home Builders Market Index declined 3 points this month because builders are saying that things are going to dry up. You've got a combination of the costs, regulatory compliance, and now the other end of the pipeline, interest rates are going up. This makes it difficult. So he made these comments after pending home sales declined for the fourth consecutive month of February. He's very worried that the market could really slow down, and to the point where, this is, again, this guy's, obviously knows what's going on in his business. I am very, very concerned that we're going to see the housing market slow down dramatically, which is a bad sign for the consumers and an equally bad sign for the American economy. We are very worried right now. Now, clearly, if you're the president or the CEO of the National Association of Home Builders, having the economy slow down, the housing market slow down, it's a bad sign for them, right? Why? Because, then, their profits are going to drop. Their margins are going to drop. They're already being pinched with respect to time delays, material delays, interest rates, whatever. So, it's going to be tough for them. But guess what? If markets slow down and prices drop, it's actually good for the consumer, okay? I don't see why this is a bad sign. Maybe the bad sign is, hey, I bought a house and I wanted to appreciate. Well, that's a little different. But as far as new home buying in the future and, existing home buying and just being able to afford a home, basically, I think that's positive for the consumer basis here. So that's just interesting that we're starting to see a lot more people talk about this right now. Hey, if you're not already subscribing to my channel and you appreciate the information I put out, if you could do me the great honor and smash that subscribe button, I'd really appreciate that. And for those of you who are subscribers or think you're subscribers, if you could just reaffirm, smash it again, because I do have subscribers that fall off every day. So thank you very much for the views, likes, comments, shares, and your patronage. I really do appreciate that, helping my channel grow. So thanks once again. All right, guys. What we're seeing now is discussion on housing affordability crisis. So I guess if you think about it, a housing bubble means things are outpacing, economy and wages and growth, and that is just becoming unaffordable, which maybe the nicer word for a housing bubble is housing affordability crisis. So basically, we're seeing a lot more discussion now as housing affordability crisis imminent as mortgage rates hit a 3-year high. We all know that they talk about the near vertical ascent. These levels have not been seen since January 2019 at an almost unprecedented speed. So obviously, rates go up, sending affordability spiraling lower. Clearly, you have less buying power when mortgage rates go up, which means it's tougher to buy a house, which means if someone wants to sell, they may have to adjust their price points downward to accommodate the interest rates. Housing affordability is about to crash the most on record. So obviously, NAR Chief Economist Lawrence Yun is stating that housing affordability continues to be a major challenge as buyers are getting a double whammy, rising mortgage rates and sustained price increases. All right. So basically, that's the whole thing. We're talking sustained price increases. Well, it's going to be unsustainable. So eventually buyers are going to pull back and they're going to go, we can't do this anymore. Sellers will have to make up their mind. Do they hold out and keep their properties either off market or on market until they get a buyer, or until things change, or do they reduce price to get what they can before things change even more dramatically? All right. Basically, Bank of America joins the chorus, warning that last year's housing euphoria is unlikely to repeat, and this year will be a much more challenging year for the housing market, given the significant headwinds to affordability and ongoing supply side challenges. Now, headwinds, another word that's used quite a synonymous, I guess, in association with the housing market. So obviously, the stronger the headwinds, the more difficult the market is, and we'll see more things, contributing to that. Clearly, they're saying here that the Russia-Ukraine conflict adds a new factor to the mix. Why? Because we're going to have consumers will be facing, already with inflation, but even more high prices for, gas and oil and stuff like that. So essentially, it's going to take more demand on your monthly income, which will be more difficult for you to qualify for loans in a high price appreciated market. So it all has a big roundabout effect on everything that we actually do here. Clearly, consumers appear to understand that they are stuck in a lose-lose situation when it comes to buying or renting. If you can afford the historically high down payment, then you will save money on the mortgage compared to paying rent, unless mortgage rates spike higher from here. So it's that kind of inflection point. Each market, is it better to rent or better to buy? Those are sort of, we'll call it, internet sort of articles put out all the time, depending on what's going on. Well, now we're going to probably see a slew of those next little while when interest rates kind of, if they do sort of plateau out. But remember, Fed has, discussed saying that they're going to raise it 6-7 times this year. Goldman Sachs says it's probably going to be 8 times. So, if we keep seeing an increase in mortgage rates, then that's going to flip-flop again. So it's like, what do you do? People are going to face some serious challenges here. Do I rent? Oh, it's too expensive. The landlords have increased to recoup from the rents, to recoup from what they've lost or the issues from the previous housing crisis. Yet prices are high and interest rates are high. So until we see some relief in that segment, who knows what's going to happen? It's going to be tougher for a lot of people for the next few months. Something has to give on a going forward basis, right? So refreshing the data. Well, here it says we looked at the NAR affordability index and found that would lead to a record affordability decline of more than 25%. So people are already predicting some declines here. Refreshing the data, Bank of America finds that the decline looks now closer to 30%. So when you have a housing affordability index going down, you have impact from rising mortgage rates going down, existing home sales going down, they look at this as that, they're predicting, same thing. We're talking, maybe 25 to 30%, correction here to make it equal out. In other words, with everything that's happening, the expectations, you got to drop about 30% to adjust for rising in rates, which would change the market dramatically as to what's going on there right now. So it's not just me saying this. Now we've got Fed, we've got banking people, we've got other economists and analysts that are in the housing market. So it's becoming, I guess, quite a, I guess it's now a openly discussed topic that we're going to have issues. Now, this is interesting here. So this article sort of goes along with this, but it goes to show that people that are associated with the industry or just commenting on the economy always goes back down to housing, right? That's where everything lasts. So this guy's name is Gary Friedman. I guess you could say CEO of RH, which is formerly known as Restoration Hardware, which really is kind of a it's a, I don't know if you've been to Restoration Hardware. It's a furniture, housing, big store, lights, doorknobs, everything, like anything you want to furnish your house or accessorize your house or build part of your house with cool furniture and decent stuff. It's a cool store if you ever go into one. But basically, it's talking about the current macroeconomic environment. He made comparisons between the great economy, today's economy, and the Great Recession. He was talking about, referencing some of the stuff that happened in the Big Short movie. He also questioned whether the housing market's current state was sustainable. So everything comes back to, is today's prices sustainable? Is today's market sustainable? Can you happily buy property and afford it, in today's market? Well, he's basically saying you've got housing prices at all-time highs. I mean, is it sustainable? I don't know for how long. The math doesn't make sense on kind of what's happening in the housing sector and other places here. So, where we are when they talk about housing affordability crisis, it just shows that we're only a small percentage of people can really truly afford what's going on in the marketplace right now. So as prices rise, interest rates rise, again, you're putting a lot of people out of the housing market. And now we've only got a small percentage of people that can actually truly afford to purchase in today's market. So something has to give. It all comes back down to when will this give? When will this change, right? That's the big, I guess you could say, roll the dice here. So as I always tell you guys, two housing markets in play right now. The mainstream retail market. I was speaking with somebody today and talking about my views on the fact that, this is the narrative, and the narrative is everything's okay. The narrative is don't worry about things. Double-digit appreciation is wonderful. You know what I mean? Don't worry about rising interest rates because your wages are going up at the same time, and if rates are going up, your appreciation is going up. So everything's going to balance out here. All right. Well, they don't. That's what we're talking about here. They don't reference the distressed issues. Okay. Last video, I showed some charts that showed the states, the counties, and the cities that are suddenly increasing substantially in foreclosure filings, right? And realize that we've had 2 years of what I call a choked market with respect to foreclosure and eviction moratoria, forbearance, things like that. Well, now all those things are over, and now that we're moving into the second quarter of 2022, we're seeing a pickup in activity on the shadow inventory foreclosure, pre-foreclosure front. We're seeing more auctions being scheduled, more homes going to auction, more people getting foreclosure filings, more people, more foreclosures restarting where they left off. So we're starting to see that. Now, where we are today is that stuff is not hitting the market yet. It's sort of regenerating and regurgitating. It's coming back, but it's not here. It's not making an impact. So right now we can talk about, oh, that's going to be great, but it's not doing anything. It's not ready yet to impact the market. It's coming, let me tell you. I look at this stuff every single day. We see increases all over the country, all right? And some locations way more than others. So it's balancing out. We don't have a balanced market. We basically have a low inventory, constrained, manipulated market right now. That's the way it goes. So thus prices and things were allowed to get out of control and end us up where we are. Fed's trying to recover now, putting interest rates up to sort of quell what's going on, to sort of bring us back down to reality, which is only part of the solution. We don't have yet the pre-foreclosures and the foreclosures that are really making an impact on the marketplace because the volume's not there, and they're not really ready yet. They're starting the process, going through the process, but they're not becoming part of the solution yet. They will. Now is the opportunity to jump on that right now, okay? Because stuff is available, it's just not en masse right now, okay? It's pockets here and there. So as I talk about the rolling statistics, forbearance numbers, talked about this. People are coming out of forbearance. They're getting loan mods, but they're not paying for the loan mods, right? A lot of delinquency not in programs. People who are in these loss mitigation programs not paying. There's estimate between 3 and 10 million plus people who are going to be facing foreclosure at any given time. Where those numbers are going to fall out, we don't know, but that's the problem. It's very ambiguous right now. But as far as I can tell you, the signs are there. When you compare what's happening to back in the last housing crisis, and clearly based on the articles I'm talking about here, there's a lot of comparison going on. I'm not the one that's making the comparisons, right? There's a lot of people talking about, hey, we see the exuberance, we see the froth, we see what's gone on. Well, as I said, the nice thing about it is that, we don't have a crystal ball, right? So it's tough to predict the future, but as I always say, we got the time machine. We can go back in time and see how it all played out and then position ourselves the right way to be able to buy homes or take advantage of the situation or realize where the opportunities are going to be. This time through, you got obviously the Fed playing more games. You got Wall Street. You got the lenders. You got big hedge funds. Okay, you've got government, local and state, and even federal governments wanting a piece of the action. You got more investor players with money. You've got more people trying to participate in this market. It's like a massive, I call it 3D or 4D chess game we're playing here. We got to outsmart all these levels and all these different players. But if you know what you're doing and you're involved in the front end of this, then you're gonna be better off. That's what I keep telling people get into this now. Figure this stuff out now because it'll be too late when it all kind of plays out. We're seeing more deaths, more estate probates, more HOA foreclosures, more layering, like multiple issues per deal, so the deals are harder to get done, right? More landlord fallout. We're going to see more unpaid property tax. I just remembered right now. I did see an article, I talked about it last video, that property tax will be rising. So that's going to impact people as well. Your escrows are going to go up on your mortgage, and if you pay your property tax on your own, that's going to increase. So we're probably going to see more unpaid property tax situations on homes and properties land as time goes on, which again will hopefully result in more opportunities if you know how to participate in that market as well. That's what we got. Hey, build to rent, build to flip. That's part of the future. Get involved with that. Give me a shout. Distressed Deal Architect, I'm looking for a mid-May start on that. It's going to be an 8-week training program. Lots of stuff, me teaching you on a weekly basis live. So if you want to get involved, let me know now. No more short sale program. As I said, it's coming back in different formats. So if it's something you want to do, give me a shout. But how the benefits of it before are no longer there, guys. So jump on, let me know. I can figure something out for you. But that's the scoop here. How to get a hold of me, Randy at luxuryshortsales.com. So again, let's look forward to what's happening. I couldn't help myself. I had to talk about, I had to make a video today just to talk about what's going in the marketplace. This is why you want to get involved with stress housing. You can get deals like this. These deals do exist. You can find them if you put a little bit of effort into them. You can work them, put some effort into them, and stuff will happen. As I said, inflection points. So right now, you know, from a macro narrative point of view, we're not going to see much impact in the housing market because the things that can make an impact or draw the price points down are not fully engaged at this point in time. Interest rates will help slow things down. Buyer sentiment being low as it's ever been will help pull things down. And eventually, as the distressed properties start coming into the market, that will help pull things down as well too. So it's what you want to do. It's what you want to be looking forward to. Is what you want to be involved with. Better to be educated in this than to be a bystander or watching it happen. Remember, you don't know that the market's hit the bottom until it's already hit the bottom and it's 2 months past, right? So people who say, I'm going to wait to the very end when it hits rock bottom to buy a property, you're going to miss that. So get involved now to figure out and know the signs and know how to track this. All right, guys, appreciate the views, likes, comments. Please share the video with your family and friends. Subscribe if you're not a subscriber. I look forward to speaking with you next week.